Hi, I'm Rick Kaler. Thanks for joining me. What's the best way to hold real estate in a retirement portfolio? For many investors, the answer, and it's not the right answer, seems to be not at all. Yet this asset class, appropriately owned, can help support you well in retirement. Unlike stocks, which are traded on a highly efficient and liquid exchange, trading real estate is inefficient and illiquid. The ease of buying and selling stocks is one of the major reasons the asset class is overrepresented in most portfolios. Based on the fascination of the financial press with the stock market, it's easy to get the impression that stocks comprise the largest financial asset class. According to Matthew Yglesias, author of The Rent is Too Damn High, and forgive me if I've murdered his name, total value of commercial real estate in the U.S. as of December 2013 was $20 trillion. This equals the value of publicly traded stock. Interesting. The largest asset class, however, is bonds, with $37 trillion, almost twice that of stocks or real estate. While one could make a strong argument for owning equal amounts of real estate and stocks in most retirement portfolios, very few hold any real estate at all. Probably the worst way to hold real estate is to own it directly. The only popular retirement plan that allows direct ownership of real estate is the self-directed IRA. Unfortunately, the government discourages holding real estate this way by taxing it unfavorably. As I've described in a previous column, it's not a good idea. Registered limited partnerships were a popular way to own real estate in the 1980s. While some must have made money on these investments, I don't think it was investors. I don't know an investor who made a dime personally, but I know some distributors and promoters who got very rich with it. The problem wasn't the real estate that they held, but the lack of transparency inherent in a limited partnership, which allowed promoters, distributors, and those selling them to hide high fees and commissions that didn't give the investors a chance of profiting. Gradually, the real estate investment trust gained popularity as another investment vehicle for owning real estate. A publicly traded REIT is similar to an ETF, that's a form of a mutual fund, that trades on major exchanges and invests directly in real estate. REITs receive beneficial tax breaks. They must pass through 90% of their cash flow to investors. They have a high degree of transparency, and they're very, very liquid. They also tend to specialize in certain types of real estate. So rather than hold REITs individually, I prefer to own a mutual fund that owns a diversified assortment. The fees and commissions associated with REITs are very low, which helps make them a good choice for investment portfolios. It's also another reason they don't often show up there, since most financial vehicles are sold, not bought. Mutual funds, annuities, and cash value insurance pay much higher commissions than the exchange-traded REITs. Well, Wall Street solved that problem by creating the non-traded REIT, which does not trade on a securities exchange and is therefore highly illiquid. The benefits touted by salespeople are the potential for higher dividends, plus lower volatility than the publicly traded REITs. As you suspect, there's a downside to them. Their lower volatility is an illusion created by their high illiquidity. They also lack transparency, kind of reminiscent of the limited partnerships, aren't they? Which gives cover to charging high fees and commissions. Yep, the non-traded REIT is scarily like its older cousin of the 80s, that registered limited partnership. Including real estate in a retirement portfolio can be a really good idea as long as the ownership is properly structured. A mutual fund that holds a broad diversification of publicly traded REITs is one way to help you build a strong foundation for retirement. Thanks for joining me.